the economic recovery, the reflation from the corona shutdowns from 2020 paused in late February on the 24th, 25th, and 26th. Paused. And it's, what month are we in? June. And it's been paused since then. The good news is I didn't say stopped. So we're in a balancing moment right now where perhaps the recovery will continue, but the momentum has been arrested, and it has been for 3 to 4 months now.
And what are the variables that lead you to that conclusion? Because if I cast an eye over some economic numbers that have come out, I look at employment numbers, which seem, okay, sometimes they're a little bit below where people might be forecasting, but they're still robust. They're still growing numbers of people working. Wages are improving. People are earning a little. People who are employed are earning a little bit more. Industrial output is improving. So what variables are you suggesting, or are you seeing, that are causing you to make the conclusion that we've seen, or we're seeing, or we are in a pause?
Those variables that you mentioned are, what would we call them? We would call them backward-looking, retrospective. Mm-hmm. Most of the time, whenever we talk about how is industrial production doing, or unemployment, or wages, we measure year over year. Typically, that's what we would do. Well, how are they doing to this point last year? Well, compared to this point last year, we're doing fantastic. Fantastic. This is the greatest global improvement year over year in broad number of economic accounts, probably since Noah, when he looked back and said, well, last year the world was underwater, so comparatively we're doing much better. I think this is the second best ever year-over-year comparison in the history of human civilization. But the thing that comes before economic activity, the thing that assists economic activity, are the money markets. The money markets are the ones that fund industrial production, employment, that provide the short working capital, the investments. And those markets are the ones that have paused. First come the money markets. They are the wellspring, the fount from which then we move on to capital markets like stocks and bonds, currency markets, and commodity markets. But the money markets are saying,
Are banks are still lending, though? I mean, banks are providing debt financing to companies. House prices, housing transactions are still increasing. Otherwise, banks must be funding mortgages and such like. So where are we? Where in the depths of this plumbing, as I think you've referred to it before? Where are we? Where are these percolating issues? So I'm not seeing them on the stuff that might be more obvious. So where exactly are these things?
Well, I think a good place that the audience can look at that is very obvious, but also still is plugged into the pipes, is the U.S. bond market, the benchmark sovereign debt. I haven't said that very well, have I? No. Let me try again. Can we rewind? We're not live, are we? Oh, my Lord. Okay, so it's the U.S. 10-year Treasury. That is a great indicator of money markets. And how is that market doing? It recovered after the corona, the COVIDs. I love saying it, the COVIDs. It's just funny for me, but no one else. We're not live, are we, Simon?
No, and no one thinks this is supposed to be a funny show either, so it's fine.
It recovered, but not very strongly, Simon. Not very strongly, despite the world's most coordinated, broadest, simultaneous impulse of fiscal and monetary policy. The U.S. bond market, which represents many things in the money markets, rose a little bit.
When you say U.S. bond market, just to be clear what you mean by rose, because
I'm sorry,
bonds are a quirky little beast. Normally,
Yes.
when you think of, I don't know, say shares in Emil Kalinowski, if they go up, it's because you've become more valuable.
Yes.
Or when they more like, no, I won't go there. But bonds, on the other hand, when they go up, people could be referring to the price of the bonds, or they could be referring to the yield. So just help me by clarifying what you're referring to there.
Dear audience, forgive me. Simon's absolutely right. I'm referring to yields in my mind. And if a yield is going up, the implication is that the price is going down. Mm-hmm. From now on, I'll just make it straightforward and say bond prices have been falling, but not by a lot compared to the previous 3 episodes of financial and regional crisis that we've had in the last 14 years. So compared to those experiences, bond prices fell, as they should during a reflation and a recovery, because you don't need the safety instrument. You don't need that collateral because the economy's recovery. Things are getting better. Get out there into the economy and invest in it. Don't hold a bond. That's what the world thinks during these reflations and recoveries. And so we see bond prices falling, but they haven't fallen very much. And, importantly, they stopped falling in price at the end of February, and they have flatlined ever since, and more recently they've started rising again.
Isn't one of the reasons, though, if I put my economist hat on for a moment, to
It's
exactly...
lovely.
Well,
Sherlock Holmes
yes.
with the 2 flaps on both sides. I'm sorry, go ahead.
It's almost too warm for one of those in this island, isn't it? But anyway,
Style first.
Style over substance.
Structure.
Yes.
Okay. That's the name of the
reminiscing.
show.
I mean, luckily we're live on YouTube, so people can see that we epitomise style, can't you? I mean, that's without doubt. And our producer is agreeing or mocking us. I don't know which one she's doing. But if
Radio K-Man YouTube, you can see us
exactly.
live.
But if I put my economist hat on, an economist will say, okay, when economic recovery happens, people tend to get out of those safe assets, so bonds, and you sell something that's safe, the price goes down. And because economic activity is stronger elsewhere in the world, in order to equilibrate the supply and demand for money, interest rates go up. So to your point, bond prices will fall, interest rates will go up, and that will be a somewhat natural check on the otherwise potentially over-exuberant economic recovery that could ensue and inflationary pressures. In this particular instance, though, to your point, we've had globally coordinated central bank action, which has been, in the main, buying assets. And one of those assets it's been buying has been bonds, precisely in order to keep yields down so as to stop the cost of funding debt for governments as much as individuals, to stop that getting out of hand. And so when you say that bond prices haven't started to go down, yields haven't gone up, isn't that simultaneously because, yes, there may well be an economic recovery, and we'll come to that, but it's partly because central banks haven't permitted it because of their scale of their purchases. So in normal worlds, if the central bank action weren't there and we had an economic recovery, perhaps bond yields today would be 2%, 3%, choose a percent higher. But they're not, and that could be a symptom that economic recovery is poor. It could be a symptom that economic recovery is missing, or it could be a symptom of central bank action. So help me with that one.
I think everyone's favorite country for the longest time was Canada. But recently...
I mean, all the Canadians that are here.
Yes.
So apart from Canadians...
Everyone loves Canadians. And they've done nothing wrong. But you know who's taken the lead recently? I would say it's New Zealand. For a number... Do you agree?
Well,
everyone loves,
yeah,
except for the Aussies.
They have better wine.
The Aussies obviously don't like them, and I don't blame them.
But they're jealous, aren't they?
Well, okay. The reason I bring it up is because New Zealand, among the many wonderful things that they do, also has a bank called the Reserve Bank of New Zealand, and they looked at this. Among many other banks, there are many studies like this, but this is the one that I most recently know.
Just to be clear, you like New Zealand because of New Zealand's central bank. We're ignoring the beauty, the people, the wine, even the lamb. None of those are relevant. It's the Reserve Bank of New Zealand.
Yes, sir.
Okay.
They put out a paper not too long ago where they analyzed the impact of quantitative easing purchases on bond yields. They said, maybe we're lowering bond yields. You know what they said? No, we're not. The market is. They said for every 10% of GDP, that's a huge amount. Mm-hmm. Huge amount. For every 10% of GDP worth of quantitative easing purchases of bonds by a government, by our central bank, we lower bond yields by approximately 0.5%. Half. So if you spend an insane amount,
of which, but in fairness, an insane amount has been spent.
So they've lowered it by approximately, so I'm guessing not really 0.5%, but almost 0.5%. But bond yields are much lower than that. What I'm trying to say is the markets still control these bond yields, bond prices, more than central banks because the markets are much larger in size. It's the central banks that are reactive. They're the ones following the market. They lower bond prices a little bit, despite all the...
So this comes to a dilemma in economics, perhaps, which is it's the marginal buyer that sets the price. It's not the amount of money that's been sent. It's not the average. And in this instance, the marginal buyer has been central banks. So there are other people who are going about their business and trading as they might ordinarily do. But then one day, this new sheriff comes into town and says, I'm going to start playing in this market as well. And suddenly, by definition, they are the marginal player. So how does research capture that sort of aspect? Because there is no counterfactual. There is no way of easily saying, well, before we did this and during, and then just pretend one day we don't do it and the next day we do, and then to assess. It's a very difficult game to properly research, I suspect.
Well, it is the longest running monetary experiment. It started by Japan in 2001, if I remember. So there have been a number of studies. And believe me, these academic studies, they don't say positive things about quantitative easing in terms of effectiveness. They say the impact on the economy is minimal. The impact on bond yields is minimal. The impact on portfolio rebalancing is minimal, despite a decade of around the world working on this.
There is the flip side, though, and I know you're trying to push me to a break, so I can't challenge this question. But I'm not going to accept that, Emil.
Susan, please go to break quickly.
There is the flip side, though, which is that there is psychology at work here. In other words, when a central bank chief says to the market, if you don't behave, we're going to do this. If you let interest rates go up, we're going to take action. There is a psychology of we could get beaten up here very badly. And so the economics of is central bank action successful in delivering, okay, it's 10% of GDP equals 0.5% of interest rates. Mathematically, that may well be the correct answer, and I'm not necessarily disputing it. I haven't done the research of that paper, but I wonder whether there's a psychological aspect, which is, well, rather like Mario Draghi saying, we will do whatever it takes to save the euro, but actually do nothing, and yet the euro was, except for Brexit, for all intents, which is not the euro, but a corollary thereof, was for all intents and purposes during that crisis saved, with no country exiting the euro.
Expectations policy, that's what you're referring to right now. The central bank president gets up there and on his or her bully pulpit pounds the table and says, do what we say. And expectations policy worked until sometime in 2007, 2008, and it's definitely gotten less and less effective. We've had now 4 global or regional monetary crises despite central bank action. So, yes, when everything was working, the Wizard of Oz, in his big green head, looked like we were going to follow it. But you know what? Toto knocked over that screen, and now we see a little man. And that screen has been knocked over 4 times, and we're looking at that little man, and he's not a great wizard at all.
My memory of the Wizard of Oz.
Let's go to commercial.
We're going to have to go to our central bank chief in the studio there and governor and send us to a commercial while I research the Wizard of Oz better.
Maintaining the innovation
on a daily basis, making it easy to connect with you, our listeners. Add us to WhatsApp today, 925-3261. That's 925-3261.
Radio Cayman.
Send a text or voice note. You don't really have to ask us. Just send a request.
This is a shout out to my ex.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
This is how we wake you up in the morning. Praise Time on Radio Cayman.
Are you ready? Here we go. Set. I feel like running, skip it, run it. Hey, let's skip it.
Praise Time.
Give me Jesus in the morning. I will. So send me, Lord. I will go.
Weekday mornings from 6 until 6:30.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense. In the first half of the show, Emile, our official prognosticator-in-chief, mused on the happenings in the economy, where we are, why we were, where we were, and why we haven't got to where we want to get to. Is that broadly right, or have I mischaracterized what you tried to say?
That's very well characterized. And during the break, Simon chided me for not being more agreeable. So now I will be very agreeable, and I will applaud the central banks. I'm exaggerating.
Chided is too nice a word to use around me. I'm much more aggressive and unpleasant than that. So I appreciate your conciliatory tone. But let's go to... We did talk before the break about the impact of central bank actions, and your argument was that they haven't been as effective as they would like themselves to have been. But let's look at the other side of this balance sheet. There are two sides to this. One is the actions that central banks have had perhaps on the real economy, and the argument you're making is that they haven't been successful or they won't have been successful in stimulating the future path of the economy. And the leading indicator of that is the fact that interest rates have not moved higher in anticipation. On the other side of the ledger, those assets that reflect the behaviour of risk, those assets that reflect the appetite of people to make investment decisions, to go wild and exude their animal spirits forth, equities, have been on a tear, have been not only recovering, are at record levels, have continued to push record levels and boundaries. So how does one square that particular circle?
Are we saying that, I don't know how to square it. Is it that the central banks are causing this? Do they want this to happen? It seems lurid that stock markets are at such highs when so many people are unemployed and the economy is in such bad shape, and not enough of us own equities, at least broadly, if I understand, around the world. It's a smaller proportion, certainly less than half. So the equities are rising in value, making those individuals wealthier, while many are not enjoying it. And that's not a recipe for what? For societal harmony?
But is there a disconnect? I guess delving deeper into that subject, though, is there now a disconnect whereby historical connections or links between economic activity and bond yields has been broken, and now we just need to say, well, okay, once upon a time there was this quaint, archaic and rather anachronistic and rather lovely thing called bonds, but really who cares? Now we live in this great new world where it's a signal that equities give as to where and what is performing. Perhaps bonds are an irrelevance. Perhaps bonds are an anachronism.
Well, that's why we need to take a look at multiple independent points of view. Bonds is one of them, and there are different monetary accounts, different capital market accounts, currencies, commodities, and we need to take a look broadly, never hold our position too strenuously, and be flexible and pliable to change our minds. But I will say that bonds are doing very well in predicting the future, and they've been doing so for decades, whereas equities are not as good a predictor regarding the economy, which is what I'm most interested in, not so much if stocks go up, good, fine.
You've mentioned that central bank action hasn't been, or isn't going to be as successful as they'd like it to be. You've mentioned that the quantum of money that is being able to be flowing through the plumbing of the system has been blocked. However, if I cast a rather uncritical eye on certain things, I can look around and say there has been a huge amount of money flowing to all sorts of other asset classes. There are, in so many cases, what I think will become extraordinarily, blindingly, seemingly obvious bubbles that can only have been created by an abundance of cash, because bubbles cannot happen unless people spend cash. So how does one reconcile the fact that there is a huge amount of cash flying, not just flowing, but flying into certain assets, AMC, GameStop, crypto stuff, potentially commodities as well. How does one reconcile that with the fact that central banks' money supply, you're saying, isn't actually getting into the system?
Well, here's my thesis, and tell me what you think of it. I think that the market participants see that we need a new social contract, a contract between government and households, the wealthy and businesses, and that the international world order is disintegrating, the one that was put into place after the Second World War, and it has been for over a decade now. But we don't know what the new international order will be. We don't know what the new social contract will be. And therefore, there is no tomorrow. We don't know what the rules of the law, the road are over the horizon. What will the regulations be? We sense, we know they'll be different, radically different, just as after the Second World War was a radically different world. We come to these moments throughout history where there's a radical change and the world before is unrecognizable. I believe we're heading towards such a moment. And therefore, if you don't know what the future laws and regulations are, it doesn't make sense to make a long-term investment into plant, property, equipment, and people. It makes sense to make speculative investments with the pool of savings. There's plenty of savings around. Take the pool of savings and make speculative investments for short-term gains in AMC and GameStop and whatnot. But that is financialization. That's not good for a society, for an economy, which should be investing in its future. But I don't blame companies and people for not investing into a future that's so uncertain. What do you think of that general thesis? A pool of savings exists. That pool is being put to speculative use. The money that could be put towards economic activity and growth, there's not enough of it, and therefore we are where we are.
I think it's a very interesting one, which I don't have a conclusion on that. I think the initial response I have is that it's probably a little early to judge whether companies are themselves putting capital to work in more speculative than longer term plans, simply because they are coming out of a rather chaotic 12 to 18 months. And I'd be willing to give them the benefits of the doubt for a little while longer, because how do you make a capital investment plan when you can't actually visit a manufacturing site in somewhere else and consider whether that's the right place to do something? So I think, one gives them the benefit of the doubt until we start to see a normalization of travel or normalization. But there's certainly been capital deployed in technology. A huge amount of money has been spent in battery technology, a huge amount of money has been spent in chip technology all around the world. Is that not good capital investment?
Seemingly, I think so, but I'm not an expert in those areas. But it seems like that's a good investment area. I'm not saying we're existing in the Sahara or something like that. There's no water anywhere, or maybe I am, and there's an oasis. Chip investment, battery investment, fine, good. But broadly speaking, we are in an unhealthy economic place, and since late February, the recovery, reflation, has paused, and I'm worried it may roll over.
So let me ask you, with the brevity of time as an important factor here, linking to all of that, are you concerned at all, and should we be concerned at all by the prospect of commodity and asset price inflation, consumer price inflation, and such like?
Concerned in what sense?
In that if the economic recovery is anemic and stalled, but costs of goods are rising because of supply constraints, because we haven't invested enough capital, and therefore we're not going to have as productive a future economy. Should we be concerned about that?
We should be concerned about, yes, rising prices in an economy that is not throwing off enough money for our wages to rise, even to keep up with those.
So
increases.
you'd be worried about future commodity price increases feeding through to the disintegration of the consumer's spending power?
I am not worried about future commodity prices feeding through unless we're talking about supply constraints caused by the virus and government shutdowns. If that's the case, then yes, I would be worried about it. But
that's potentially a temporary phenomenon. That can be resolved once the virus is more under control.
I feel, yes, I think so. I'm more concerned the economy is unhealthy, weak, and will continue to be that way.
Okay. Emile, thank you. We are,
Simon.
what are we, 1 minute away from the end. Dare I ask you, do you have anything that you want to say in respect of Bitcoin? Tell us the 30-second view you have of this, just because why the devil not?
We were talking before the break that I thought this was the world's first global bubble where everyone can participate. Now, gold has also been in bubbles. That doesn't mean that the underlying instrument is worthless or should be disregarded, but it does mean it can get overwrought. And I think this is history's first simultaneous where everyone can participate because we're all networked, whereas the 30 seconds are up. I wanted to go into the Mississippi bubble and the South Sea bubble, but we couldn't all participate at
Well,
that.
you can put all those on your Twitter account and we can all be better informed.
Thank you, Simon.
Unfortunately, we've lost a listener as Adam Newman has choked on his cornflakes, having heard you describe Bitcoin as a bubble. So someone please in West Bay put the Heimlich maneuver together for him. So again, Emile, thank you very much. Time has, unfortunately, the arrow of time has moved forwards. There has not yet been a solution to that. We continue to expire as time goes through. But it has been my pleasure having you join the show today. It's been a while since you've joined us. I hope the interlude until the next appearance will not be as long, but thank you.
Thank you very much, Simon.
Finally, just before we depart, a quick reminder that Money Sense is available for viewing through and on the CFA Society Cayman Islands webpage, as well as on YouTube. We post stuff on LinkedIn and all sorts of other social media, including Twitter. If you have any questions, topics, or conversations you'd like us to join in, email us at moneysense@candw.ky or tweet us at MoneySense Radio. With that, thank you again for joining us, and please do tune in 2 weeks' time.